All right. Well, maybe. So I'll just start. So I've been investing for a long time. I bought my first shares when I was 14 years old. My grandma was kind of a big investor. She was a school teacher, but despite being a school teacher, she was able to kind of through the magic of compounding and stock market returns, she was able to retire comfortably just investing. Her and her husband, my grandpa, were both school teachers, and were able to technically, I think, be millionaires by the time that they retired. And so that got me really interested in investing when I was a teenager. And so at 14, I bought my first shares, and that was right before the that was kind of right during the height of the dot-com bubble. So I kind of experienced that, and I think it kind of lured me in because everything was just going up. That was, that was that time, and shortly after that, things crashed, and kind of my first real losses as a teenager. Of course, not a ton of money, but I was interested, and so I just continued on from that point forward. Fast forward, it wasn't until 2010 where I kind of started getting a bit more serious about investing in options. I was in law school at the time, and kind of as a way to earn some extra money on the side, I started reading books on options, and started doing it myself, and had some success there. And I kind of since then have been primarily an investor through options. So I don't, I still buy stock and shares through my retirement account, but I've found that options give me much more flexibility. And we'll talk about why that is in a minute. Those of you who kind of know about options probably have already discovered this. And so I've been doing this, now for about 10 years with options, and still learning and still reading everything I can. But I thought it would be fun to, try and share what I've learned over the last 10 years with other people. And so that's why I started this course. Danny, do you want to go ahead and introduce yourself?
Sure. I'm Steve's brother, Dan Barnes. A lot of what Steve said would have been partially my upbringing too. It was my grandma who originally kind of got me into it as well. But unlike Steve, I didn't quite follow the path as diligently through life as he did. So as I got older, got interested in the stock market and options trading again. And so I've actually just been working closely with Steve for the last couple of years, learning everything I can from him. And then now I'm super excited about kind of this whole package and this course that he's putting together, because I know what I've learned from him so far. So I think that's going to be exciting. But yeah, I'm just interested in learning a bunch of strategies and figuring all that out. So that's.
Thanks. Tim, do you want to introduce yourself briefly?
Yeah, I'm much older than you guys, and I got into long-term investing from Phil Town, from my daughter. She went and seen one of the events in Edmonton. Mm-hmm. So I just started reading a lot about Warren Buffett, really, and then jumped into Phil Town and the podcast with Danielle and all that. So I think, Steve, you were on one of those Facebook pages or groups.
Yeah. No, I'm a big Phil Town fan. So I probably read his books only about 2 or 3 years ago. I've always kind of been my investment style and philosophy is more in the value investor camp, which is odd since I like to use options, and so those two don't go together very often. Yeah. You don't hear about that very often, but so I was interested to hear that Phil Town, likes to use options. But so yeah, when I read his books, I thought a lot of what he had to say is really good advice for everyone as far as investing, and I like the 4 M's, right? And so I think that's critical in anything that you do investing wise. How many of you guys are students of Phil Town's course?
I am.
Okay, Marnie is.
Yeah.
So am I.
Okay, all of you guys. And are you doing that 6-month course?
Who are you talking to?
All three of you?
I'll start. I'm Marnie. Another Canadian. I'm from Victoria. Hello.
Okay. Nice.
I went down to San Diego in February for the 3-day, and then about a few weeks later started the. I just bought into the first 6 months of training. So right now, the first 3 months is learning, and the second 3 is practicing. So we're just started the practicing. But it was they started out with options, but it was fairly limited to what they call Rule 1 puts, and mostly to bull put spreads, and that just with rut. And so the rest of it was all about evaluating companies and so on. So I found we didn't get far enough for my satisfaction with options, because I was hoping to be able to knock down some of that course cost, and missed March 23rd because I didn't feel confident enough to buy.
Right.
Bummer, but anyway.
Yeah, no, I think all of us wish that we would have put more in March 23rd.
Yeah.
So you're not alone.
I better not.
Uh-huh.
Oh well.
Salim, did you want to introduce yourself briefly?
Sure. Yeah, so I'm from Calgary, Alberta, Canada. And I have been investing very short time also. I just got introduced to Phil probably last year, close to the end of the year when he came to Calgary. And then I did sign up for the 6-month course, and just like Marnie said, there's the first 3 months and the last 3 months. I'm on the last week of the last 3 months. So just about to finish the full 6 months, and probably next week, I think, is the last class. And like Marnie said, the same thing. I was hoping to get more out of it about options, but the first 6-month course mainly touches, like she said, on the Rule 1 put, or the I guess it's called
Full put
a
spread.
naked. No, so they do puts. They sell puts.
Sell puts, and then just with the idea
cash
that
covered puts.
yeah, okay.
To kind of to buy companies, the companies that you're researching, and wonderful companies that you want to buy, rather than just buying them outright. You sell
Kind of
puts
wait for to get to your price, essentially, right?
That's right.
Yeah.
Yeah, exactly. And then the other thing that they teach is the credit spread, which is on the rut system, on the rut trade, and they do credit spreads for what's it called? They do it on they call it bull put spreads. Yeah.
Okay.
Yeah.
Oh, go ahead, Marnie.
Just the monthly ones. They didn't want us to do the weekly ones.
Yeah. And so the next 6 months, if you pay for the next 6 months, which I didn't do up front, is that where they get into advanced option strategies, and they teach you butterflies and condors and all the works.
Yeah. And go ahead, Marnie.
Sorry, I was gonna say, are you gonna do it?
Am I? Oh, it's a limb? Okay.
No, I think I want to see how Steve does first, and then I think hopefully learn enough.
Yeah.
Well, the good thing for you guys is since you guys are kind of the early adopters and the ones that can help figure out what the curriculum looks like. I mean, you can have direct input on this because so I've kind of gone through these Teachable. So Teachable is a platform that I'm using, and they've got their own courses, and they've got a lot of experience and wisdom behind creating an online course, and a lot of what they say makes sense. But one of kind of the core principles is to start out with a group like this that can help shape what the course looks like, what people are actually interested in learning, right? So that we don't necessarily cover stuff that nobody cares about. So kind of as we go through this, if you have suggestions or questions or things that you'd like to learn, then definitely voice those either on these calls or in the
Yeah.
Discord, right? And then we can kind of go over those things and explore those
It'd be
things.
interesting to know if you knew how to teach, as well as whatever you are teaching, which ones, if you knew how to teach any of those ones that were on the list. I think another one was like Iron Condor.
Yeah, the Iron Condors. So I mean, Iron Condors, if you'll find that that's one of the most popular trades. There's kind of two different camps when it comes to those, and we can talk about those a bit. Oh, looks like somebody else is trying to join the course.
And just while Steve's checking on that, I like I said, I've been learning from Steve for a long time, and yeah, he knows all about all those different strategies, the butterflies, the Iron Condors. He does spreads, but what are the diagonal spreads, calendar spreads, all those different things. And there's a reason that you would use each of those too. So that's definitely.
Yeah, but I guess what I will tell you is, in my experience, that while those are all cool strategies and good to have in your back pocket, I would say that you would use them sparingly, because it's kind of the saying that kind of small and simple things work best. If you get too complicated and fancy, you can wind up in trouble really quick. And things, yeah, in my experience, kind of simple strategies, if you master those, is better than trying to be like a jack of all trades and using all 17 knives in your drawer. If you just stick with a couple core strategies, maybe you use those 17 knives every once in a while, but you're going to use 2, 3, or 4 kind of day in, day out. So while those are kind of cool to learn, I don't think you need to master those to be able to make some real money in the market.
The Iron Condor is the one that he sort of he got into a bit at the 3-day thing. When I don't know anything, and I don't follow what you say. That's okay. Just with something about, oh yeah, you can make double on this one. That's all I remember.
Yeah, we'll go. But so I'll take that suggestion, and we'll probably we'll go over the Iron Condor at some point during the course.
Yeah.
It has its like benefits for sure, the Iron Condor. Steve and I actually had a conversation about the Iron Condor about 2 weeks ago, in the fact that both of us over time have kind of realized the Iron Condor as kind of an entry strategy is something that we both never really use. But we do end up using it in the fact that, like, when I'm making adjustments, so I might enter into a spread, but if things start going against me, I can make an adjustment strategy using another spread on the other end, which then in essence creates the Iron Condor. So I end up with Iron Condors, and I've actually done really well in those situations. So that's like another, it's like going from a natural spread and altering it and changing it into an Iron Condor is a pretty effective strategy at times. So
it's basically a combination of a bull put spread and a bear call spread, right? But you could put those two legs on at separate times, and that's typically how I like to do it. So I see Janelle joined us. Janelle, can you hear us?
She has the mic off.
I think she's on mute.
Oh,
Okay.
she gave a thumbs up.
She gave a thumbs up. Okay. Well, Janelle, feel free if you want to comment, or if you have any questions, feel free to chime in. We were just going through and introducing ourselves. Did you want to introduce yourself, or do you want Either way is totally fine.
My mic's not working.
Okay, well, we'll just keep going along. So, okay, so now we've kind of introduced everyone. I scheduled this for an hour and a half, so we're about 24 minutes in. So we'll just go through as far as we can get. And then, so if you do have questions or comments, feel free to ask them, because I don't want to rush everyone. We can always do another session, right? So I did put together a presentation here. Let me just see if I can share my screen. I'm going to turn off my video now, and then you'll just hear my audio.
Did we maybe miss the X1NL13 person?
Yeah, I think we thought that might be Marnie. You might have like two devices going, or is that someone
I think
else?
that is somebody that's on our Discord. There is a name like that
Oh,
on our
really?
Discord.
Okay.
So, yeah.
Well, if it's I don't know if it's he or she. I think it might be she, but if you're not in a position to
they're in
introduce yourself,
Australia.
then no worries. But if you would like to introduce yourself, feel free. Okay, we'll keep moving on, and feel free to chime in. Okay, let me know if you can see my screen. I'm going to go ahead and share this. Okay. I think we'll get better as we go along, as I kind of like master the technology here. All right, let me know if you can see this slide.
Yeah, I can see it.
You can see it? Okay. All right, so the first thing, so I guess this is the agenda here. Kind of what I was thinking of getting through today. I don't know if we'll get through everything, we'll see. So first want to talk about the worst call in Super Bowl history. And Danny, you're a football fan, so you can help me with this. I'm not a huge football fan, American football. But we'll talk about that, and then I'll kind of share with you the reason why I'm sharing this story. It will kind of tie in at the end here. And then I want to talk about options, which I think for you guys, I think we can breeze through this part because you've gone through Phil Town's Rule 1 course, and I think you know the basics of options. But we'll kind of look at it maybe in a slightly different, from a slightly different perspective than what you typically hear. And then I also want to go through option pricing and help you understand how the market prices options and why that's to your advantage. And then I want to talk about debit spreads, which is kind of the core strategy that we're talking about for this, what I'm calling the 10K options challenge. Now, this is, it's still a very difficult feat. I think you saw in my post, kind of I built this model around, what would it take to take $2,000 and grow it to $10,000 without having to do a ton of trades, using a debit spread strategy and doing that in 12 months. And so I think it is certainly possible, and I know people who have done this, been more ambitious than this, and have done it repeatedly. It does take a lot of discipline and does take a lot of practice. But this is one of those things where you shoot for the moon, or you shoot for the stars, or whatever it is the saying is, and maybe you'll hit the moon, right? And so you may not get to 10K, but hopefully, as you master some of these things, then you'll be able to see how you can compound your money fairly quickly using options. And what I always like to tell people, people kind of hear the word option and think, oh, this is super risky, right? These are risky. But you've got to think, since you have this kind of inherent leverage when you're using options, that means you don't have to use as much capital. You don't have to risk as much capital up front to make the equivalent amount of capital you would make from a larger stash, right? So you're risking less and making more on that, rather than risking more and making a smaller return on that bigger pile. So, and we'll go through that throughout the course. Looks like.
Steve, that's me. I'm trying.
Oh, okay.
I just hooked it up. I was talking, like doing this on my cell phone. So
you got the laptop?
I just downloaded it on the laptop, so I'm going to change over.
Okay, great. Yeah, the
Okay.
laptop will probably be a little bit better.
Mm-hmm.
All right. So in 2015, the Seattle Seahawks and the New England Patriots were in the Super Bowl. And Danny, correct me if I'm wrong, but wasn't that the Seahawks like first time to the Super Bowl or first time in a long time?
They had just won the year before.
Oh, did they? Okay.
They beat the Broncos, the Peyton Manning
Okay.
Bronco, and that actually might have been 2 years before.
Yeah. And I don't know in Canada, since we've got a lot of Canadians, is American football popular in Canada or is it not?
Oh, yeah.
Yeah?
Somewhat.
Yep.
Somewhat. Okay.
NFL, yeah. Well, we've got the
NFL football.
NFL, that's national.
Yeah.
Yeah, somewhat.
Somewhat. Okay.
Is that just, I don't know. I'm not a football.
I only follow the CFL up here, Steve, so just that's why I'm saying
Oh,
somewhat.
CFL, that's right. Okay, ask him.
I don't follow the NFL, but I know
Yeah.
people that do. I have a brother that follows NFL, so
Well, it's very popular here. So
I know it's been around a long time.
Yep.
Yeah.
So so it's a very controversial call that the coach made, and he got a lot of flack for this call. And so we'll kind of provide the setup here, but basically you can see in this image there's about 26 seconds left. It's the end of the fourth quarter. They're down by 4 points, and a touchdown, for those of you who don't follow football, you get 6 points, right? And then you can kick another point for an extra point, so you get a total of 7. So if they make this touchdown, cross the goal line and make the touchdown, they win the game, they win the Super Bowl. So lots on the line. It's second down. So in football, you have four tries, right? 4 downs. So that means they've got 3 more tries left. They've got second, third, and fourth down to go, and they have 1 timeout because managing the clock is critical at this stage, right? You only have the 26 seconds or so left, so you can't waste time. So on this second down, instead, everybody thinks that the coach would call a running play, and I forget the name of their running back, but he was pretty good, right? And there's like, why not give it to the star running back? It's 1 yard. They've got 1 yard to go. He can just punch it in, right? But instead of running a run play, the coach tells the quarterback, Russell Wilson, to pass the ball, right? And so he passes the ball, and it's intercepted. You can see that guy, the Patriots guy there. It kind of slips through the Seahawks guy's hand, and it's intercepted. That means the game's over because now the Patriots ball, they just waste the rest of the time, right? So that won it for the Patriots and Tom Brady again. And I dislike the Patriots because they always win. So I'm just going to show you.
The running back is Marshawn Lynch.
Marshawn Lynch.
His nickname, for anybody who might have heard it before, is Beast Mode. Yeah, he was a top-tier running back for several years.
Okay. Let me just show you this clip so that you guys can see what exactly happened here. I hate this Zoom thing. It makes it so cumbersome to switch screens. All right. All right, let me know if you can see my little YouTube video. Can you see that?
Yeah.
All right. Make sure the audio's on. Hopefully you can hear the audio. We'll see.
Nope. No audio.
They'll show it in slow motion.
Yeah.
It's pretty choppy, too.
Oh, really?
Yeah. It's like frame by frame. Yeah.
Can you hear the audio?
No.
No.
Oh, you can't hear the audio? Okay.
It's a dumbass move.
I'll just explain.
Oh, gee.
Are you there still, Steve?
Okay, let me just stop this here. All right, so I guess we now know that you can't really show videos through Zoom. So there's no audio at all?
Wow.
Okay, well, I'll just kind of paraphrase. I mean, you can hear the announcers saying that this is one of the dumbest calls in all of NFL history, right? Like, this will go down in history as the worst call by an NFL coach in the history of football. So, you know, kind of that's the conventional wisdom, right? Is that this is a horrible call, but was it really the worst call in Super Bowl history? Did Pete Carroll make a horrible decision? You know, many people, most fans believe so. I mean, he let down the Seattle Seahawks. Everyone was outraged that, you know, how could he do this? This is unthinkable, right? So there's a book, a very interesting book. If you have a chance to read it, I'd encourage you. That I came across a few years ago by Annie Duke. And Annie Duke, she's a cognitive psychologist. I think she's Canadian, by the way. And she was, I don't know if she ever completed her PhD in psychology, but I think she dropped out and she became a professional poker player. Her brother, I forget his name. Do you know his name, Danny? He's a professional poker player as well. Anyway.
Yeah, shoot, I'm trying to remember his name.
Yeah.
But yeah,
So,
he's in a lot of trouble because he was involved with the whole scam with one of the internet poker sites that
really?
stole a bunch of money.
Well, Annie Duke, so
Howard Lederer, that's his name.
Oh, Howard Duke?
Howard Lederer.
Oh,
Her
okay.
Duke is
her married name. Okay. So anyway, Annie, she wrote this book called Thinking in Bets, Making Smarter Decisions When You Don't Have All the Facts. And I think for anyone serious about investing, this is a great book to read. And in that book, she tells this story about Pete Carroll and the Seattle Seahawks in 2015 at the Super Bowl, right? And this one play. And according to her research, the probability of an interception on a short pass like that, if you go back and look at all the data through NFL history for like the past 15 years, is about probably below 2%, right? So he's got like the coach is probably thinking, we've got a very small chance of an interception on this play, right? Moreover, if the pass is incomplete, this is probably what the coach is thinking, the clock stops on its own. So if you do a run play in football, apparently, let's say you don't make it into the end zone and you get tackled, the clock keeps ticking. And so all your guys have to take the time to line up again for third down, and that's going to eat up a lot of your time, right? You may not have time for a fourth play. You may, you know, if you get tackled on second down. So that you know, those are kind of the factors that Pete Carroll was probably taking into consideration in calling that play. And when you look at it from that lens, you can see how that was probably the best call he could have made, given the facts that he had, given the circumstances that he had, right? And so, was it bad call or bad luck? And I would say in that situation, it was really bad luck. But the problem is people often mistake a bad luck for a bad call or a bad decision, right? And I think you as an investor will be constantly questioning yourself whether a particular investment, once you lose money, you know, you may feel like, oh, I don't know what I'm doing. You know, was this a bad call? But it could just be bad luck. And in investing, to be a good investor, I think you have to get used to and understand that not every single one of your trades or investments is going to work out, and they're not all going to be winners, right? If you bat 60% or 70%, you would be a phenomenal investor, which means you're going to lose 30 to 40% of the time, right? That's just the nature of the beast. And so the reason I bring up this story is that I think this is one of the most fundamental things to learn. It's not about learning finance. It's not about learning how to calculate a fair value or find a quality company. Those are all important things. It's not about, knowing, being an option ninja, knowing all these different strategies. I would say the number one thing, the number one skill that you need to have as an investor is to kind of know your own mind and to understand your own psychology and biases, right? So Warren Buffett has famously said that it doesn't take a high IQ to be successful in investing, but it takes understanding your own behavior and biases and learning from them. I think that's absolutely true. He often says you don't need a PhD, right? You don't need a degree in finance to be a successful investor.
I think one of the best ways I've heard it put is to not, something especially with options, to not be results oriented. Because you could have the right process and do everything correctly and still have the trade go against you. But if you do it enough times correctly, you'll come out ahead in the end. So it's kind of like, don't measure things necessarily always by the end result, but measure things by the process that you've taken to get to that, and you tweak your process accordingly.
Yeah, I'm glad you brought that up. That's a really good point. Yeah, I think that's the point I want to make, is to be more process oriented than outcome oriented, right? So do not judge your skill as an investor necessarily on particular outcomes of a given trade, but judge your skill as an investor of whether you went through the correct process and were not swayed by different kind of natural human biases that tend to creep in, fear or greed, those type of things. So on the screen here, I've written that our human biases lead us to think that if we have a successful outcome, maybe the trade made us money, we were successful on the trade, then we must have made a good decision, right? When in reality, it could have just been dumb luck that you were successful on that particular trade. And then if we have an unsuccessful outcome, oftentimes what we do is we actually don't take the blame for it, and we just say, oh, that was bad luck, right? We kind of put off blame. So we take credit for the good outcomes and we don't take blame for the bad outcomes. And this makes it very difficult for us as humans to learn how to make better decisions and improve our overall decision making. So I think the number one thing you need to do to become a good investor is to become a great decision maker. So how do we make smarter investment decisions, right? Especially when we don't have all the facts, which is pretty much always the case in the stock market. Number one, don't believe you're smarter than most people, and just recognize that there's a lot of uncertainty always in investing, and embrace it, right? You're not going to know for sure, is this company going to do well in the next couple of years? You're not going to know what the macro situation is going to be like. Nobody really knew that Corona was going to happen, right? Like it did. So you've got to embrace, there's always going to be uncertainty in the market, but you use the facts that are available to you to estimate the probability of various outcomes. And then, you can work within kind of those probabilities based on your own kind of research. And then resist the tendency to equate good outcomes with skill and bad outcomes with luck, right? Try and really find the truth. Was it, were you sticking with your process? If you truly believe that you've got a good process in place, then stick to it, and have faith that the numbers are going to work out, right? If the probabilities are in your favor, the odds are in your favor and you're investing that way over time, things should work out for you. So any questions up to this point? Maybe I'll pause here. Okay. So so now that was just kind of the first part of the lesson. So this is kind of the second item is understanding options, and kind of you guys probably all know the classic definition of like a call option and a put option, and the right to buy a stock at a certain price is the call, and the right to sell it at a certain price is a put. But what I like to when I think of options, I like to think of it in terms of gaining or accepting exposure to a certain price range for a certain time period. And I'll show you with some charts in just a second.
Exposure is a term I got to get used to.
Exposure?
Yeah.
Yeah. So really, when you're buying an option, right, you're buying a contract that gives you either. So, for example, if you buy a call, you're buying a contract that gives you exposure to the upside above some strike price, right? And you can decide what that is for a period of time.
Mm-hmm.
If you buy a put, then you're gaining exposure to downside below a certain strike price. So you make money if the stock goes below that strike price.
Okay.
Right. And then on the flip side, when you're selling a call, what you're doing is you're actually taking on or accepting exposure to the upside. So if the stock goes up, then you lose money, right? And then if you sell a put, you're accepting exposure to the downside. So like those protective puts that Phil Town teaches, right? So you sell a put and the stock goes down below your put price, then you're going to be losing money, and you're accepting the exposure that somebody else has sold to you. Or I should say has bought from you. So here's kind of a chart. This is a Berkshire Hathaway chart. Just thought because we're talking about Warren Buffett, we might as well show his company on the board here. So when you buy a call, you can see in this example, I'm actually buying the $180 call. So that's the strike price, is this orange line. And the green just represents, this is kind of your range of exposure, right? And actually, so I was assuming you're buying the September 18th. So you can see this line stops here. This green stops at September 18th. So for this period of time, you have this upside exposure. And when you just buy a straight up call, technically your gains are unlimited. So that's why it goes all the way to the top, doesn't stop, right? So if the price kind of trickles into this green, then you make money. And but technically you've got to look at the break even, which takes into account how much you paid for the call. So when I looked at this the other day when I was putting together the slides, you could buy this $180 call for $7. So in reality, you'd have to get above this blue line to make money before expiration, right? Well, I guess I'll put a caveat on that, and we can get into it more later. But so you can still make money. That's just at expiration. At expiration, it has to be above this line to make money. If it goes up some and it still hasn't passed the break even, you could still make money. It just depends on a number of factors, and we'll go into it. But there's time decay. So as time goes on, your option is losing value. So if your stock does not go up fast enough to counter the time decay, then you could lose money. But that, for now, let's just say green means you make money, right? To make it simple, and below that, yeah, you're losing money. So that's just a straight up call option. So if you're selling a call though, then you are selling the right to somebody, for somebody else to buy the stock from you, right, at $180. And so as the stock goes up, you're losing money, right? So you're accepting this exposure. So it's the opposite of the previous slide. But you get to keep the premium, that same $7. So if you sold the option, you pocket that $7, which is really 700 because options are in quantities of 100 shares. And so anything below it, you would pocket and make money.
So should that red line start at the break even? The red block?
Yeah, so so kind of ignore, these are just rough approximations. So you would actually be anything below, so you would pocket the full premium of 7, anything below 180, right? But let's say it was at 185 at expiration, then you would pocket $2. So yeah, you would still have some gains anywhere in here. It's just you wouldn't have the full gain of $7. And we'll get into the more detail later, because it is kind of hard to wrap your mind around without having several examples. But when you sell a call, you pocket the premium, so the $7, right?
Mm-hmm.
And then you pocket the full thing if it's below 180, because then that option expires worthless. But if it's above 180, that option is going to have some value, and so you would have to buy it back to close out your position. And so if it's like at 182, that option would have $2 in value. It's just $2 above 180 times 100, so $200 in value. So you'd have to buy it back for 200 to close out your position. So you pocketed 7 up front, you bought it back for 2, you would net 5 in that scenario. So yeah, anywhere in between here, you would still profit. It's just the closer you are to this blue line, the less profit you would have. And above this line, you would have 0 profit. So, but we won't get into the weeds on this particular in this session. So a put, if you buy a put, you are gaining exposure to the downside, right? So again, you're right, Salim. Like you at expiration, you would actually lose money between these two colors here, the orange line and the blue line. You would actually have to get past this blue line to make money at expiration. That's the key. Prior to expiration, it's a little bit more nuanced. You can still make money as the stock trickles down, as long as you're keeping ahead of time decay. And then if you sell a put, this is your kind of, I guess, what you guys have learned. You pocket a premium. If the stock doesn't get below your strike price, then you pocket the full premium, right? If it gets slightly below your strike price, but not enough to counter your premium, you'll make some money. If it goes below this break-even price, which is the strike price minus the premium paid, then you lose. You start losing money.
Yeah.
Yeah.
We didn't do anything on this side of it on the call. Or, sorry,
okay, so you haven't done.
I'm a little bit lost here.
Yeah, and feel free to ask questions and let me know that.
Like I know the logic of what we're doing with the spreads on the other side. When I say the other side, the puts. Over here, what is our objective here? We're trying to, like, does it compare to, how does this type of, we're doing a spread, right?
Yeah,
How
so
does it
what we want
compare?
to
Sorry,
what we want to focus on in this lesson and kind of the main strategy we were going to talk about in this course, but again, like I said, this course is still kind of open-ended as it's being constructed, so we can throw other things in there. But I did want to talk about what's called a vertical debit spread. Sometimes it's also called a bull call spread. So you kind of think of that in terms of how Phil Town is labeling them, right? He calls that, the one that you guys are learning, the bull put spread. This was a bull call spread. In Phil's case, you guys are selling a put and then buying another put below that.
yeah.
So that's a bullish trade. You're wanting the stock to stay above that certain strike price that you sold. With this strategy that I'm teaching, that's a bull call spread, we're using calls. We're not using puts. We can, but let's focus on the call side for now. So you're going to, and I don't have it up on my screen, the diagram to show you, but essentially you would buy, for example, $180 call, which means you have the right to purchase the stock for $180 anytime between when you purchase it and the expiration date. So in this example, anytime until September 18th, 2020, you have the right to buy the stock at 180, right?
Okay.
So if the stock shoots up to $200 at expiration, then the worth of that call would be the difference between $200, the current price, and your strike price, or 80, right? So it would be worth $20 because you can go, you have the right, or you have this contract that says, Marnie, you can go and you can buy 100 shares of Berkshire Hathaway for $180.
Mm-hmm.
But if you have that right and you can do that, and the stock price is now at $200, what you would do is you would buy 100 shares for 180, and you would turn around and immediately sell them for $200, right? And you would be
Right.
pocketing $20 profit on each share times 100 shares, right? So that would give you $2,000 profit.
I like that.
So yeah, so it's nice. So you can make, we said this is real price, right? You bought it for $7. Potentially, if it gets up to 20, it'll be worth $2,000. Well, it's $20 times 107. So you spent $700, and you could sell it for $2,000.
Oh, quite different.
Yeah. So that's just a straight up call. So you're buying exposure to the upside. So it's just like you own the shares, right? And we actually will talk about, probably not so much in this particular session, but we'll talk about this metric that you can find for any option that's called, there's 4 different Greeks that you may have learned about from Phil Town. I don't know if how much he talked about this.
No, just delta.
Okay, well, delta is what I'm talking. That's the most important one, right? So delta tells you how much your option will increase in price for every $1 increase in your underlying stock. So if Berkshire Hathaway goes up $1 and you own an option that has a delta of 50, then your option should increase by $50 for every $1 that the underlying stock increases.
We didn't learn that. It just said, don't buy if it's over 10.
Yeah, and so that's Okay. Well, no, this is good because this helps me know maybe what we should talk about in future sessions, right? And in
It's
recording
good to
sessions.
know what it means, because and then we were going by that, and also by floors. And so when we bought it, it's like, make sure it's 2 or 3 floors down.
Mm-hmm.
And so they were way far away from the.
Yeah, when you're selling puts, right? Yeah, I mean, if you want to increase your chances of not losing money, then you
Yeah.
want to sell a put that's pretty far down because the likelihood of the price getting down there is small. And when you're
Yeah, and
selling a
what you
put, you
got
don't
was
want it to get down there, right?
what you got back was small too. I couldn't figure out the logic of risking, thousands and thousands of dollars to come away with, $150.
Yeah, no, I agree, and that's kind of why I've gravitated more to these buy strategies rather than sell strategies. So you've got two kind of camps in the options world. You've got people who like to sell options and collect premiums. The problem is you often will be collecting a small amount and risking a large amount, right?
Exactly.
And the probabilities say that you will win
Yeah.
more often than you lose in those trades, right? But if any of you have you heard of a book called Fooled by Randomness or Black Swan by Nicholas Taleb? So there's a great book. He actually wrote it right before the financial crisis in 2008. But he talks about how there are rare events that seem super rare and the likelihood of them happening is not very high, but they happen a lot more often than we would like to admit, right? Especially in the financial markets, right? Which we kind of witnessed this year. And so I think they thought, the probability of that crash in, what was it, 2008, that was like, it broke all the financial models. Like it was like 1 in bazillion chance that we would have a crash like that, that the housing market would crash like that, right? And so they found that these models are not, and this actually gets to what I'm getting at in this lesson, is that these models are not built for the real world. And so you can take advantage of them. I just find that if you're selling options, you're actually assuming that the world is this nice, normally distributed world where things kind of happen as expected within this range of probabilities. And when you buy options, you're actually saying, no, I don't believe the world is that clean. So we'll get into that in just a second. So let me move on, and we will do some more work
Quickly
on.
too, Steve, just from listening to maybe where, especially Marnie's saying that she's at as far as what she's learned or heard, sometimes I think it's just the benefit to doing a course with Steve is really he can get into the details of how everything works, how everything connects. Because if you really understand how things are, put together, then you can ascertain for yourself what's important, what you're looking for. You can understand what you should do in certain situations. So yeah, I think it's
I think it's the more you know, the better.
Yeah, definitely.
So just quickly, Steve, before you go on, so the idea here, I think, quite obviously. Okay, so you're trying to get this. You want the stocks to go up as much as possible from from the strike that you brought it at.
Yeah.
So however much it goes up, is how much your gain is.
Yeah, the more it goes up, the more money you make.
And then if it goes down, is it?
Yeah, I'm glad you asked that. So in this,
or is it just, what's the word?
Whoops.
Is it just fizzle?
Yeah, this is also a great feature about options, and this is why I kind of said at the beginning, I actually think using options in a lot of ways, and I would go toe to toe with anybody who would want to argue this with me. I think options are actually less risky than buying like the stock, and oftentimes, because your max downside, so you paid $700 for this option, this $180 call option.
Oh, yeah.
Right? The most you can lose is what you paid for it. So that's your max loss on a call
Oh,
option.
okay.
So if, let's say you bought this back in, like, what was that? End of January this year, before everything kind of started cratering, right? You know, which you can see in this chart, right? So
Mhm.
let's say you bought like a call option up here, like a $220 call option, and let's just pretend you paid $700 for it. Things just all of a sudden crater down to 165
Mhm.
in just a matter of a couple weeks. The most you would lose is that $700, right? If you owned an equivalent amount of stock, exposure wise, so that option, if you buy it right, if you buy a strike that's at the same price as the current stock price, your delta, just as a FYI, will be about 50. So that's called at the money. So when you buy an
At the
at the
money.
money
Yeah.
call option or puts have negative delta though, but if you buy an at the money call option, it's going to be 50 delta.
Oh.
So it's when you have a 50 delta or whatever delta you have, you can also think of it as how many shares of exposure you have. So a 50 delta call option gives you the same upside exposure as owning 50 shares of stock. And so you can also do the math and see how great of a deal you're getting a lot of times. You're getting 50 shares for $700. If you were to calculate how much 50 shares at $180 would cost you, I don't know. I don't have my calculator out. I actually can pull it up, but yeah, that would be $9,000, right? So it would cost you $9,000 if you just went and bought the shares, or you can just buy the call for 700 and have the same upside exposure. But if you bought the shares, and let's say it craters from 180 down to I don't know, 140. So let's say you lose 40 times 50, right? So if you lost $40 a share, you would lose $2,000 if you own 50 shares, right? But if you own this call option here,
Mhm.
I don't know. Can you guys see my mouse when I like move it around?
Yeah. Yeah.
Okay, I didn't know if I was just like moving it unnecessarily. But if it cratered down to 140, you would lose $700 in the option scenario versus 2,000 if you own the shares of stock.
Isn't it kind of a white knuckle ride with the volatility right now?
With stock or with options or with
And
both?
with the options, it's like, ooh, what's it gonna do tomorrow?
Yeah, it can be, and that's one reason why kind of in this introductory course, I'm kind of advocating debit spreads, or this vertical, I guess we call it bull call spread, because what you're really doing in a bull call spread is you're buying one option, let's say this 180, and
Mhm.
then you're selling another one just above it. So you would
Oh,
sell the 185. And let's just say, for purposes of this example, you could sell the 185 for, let's just say you could sell for $5, right? So you bought one for 7. I guess this is back here when we were entering the trade, and sold one for 5. That means your net cost is $2 or $200. But what you just did there by selling the 185, which would be approximately like kind of right below this blue line,
yeah.
you would cap your gains at that level.
Right. Right.
Okay. But if we did the math at expiration, if the stock is anywhere above 185, that spread should be worth the distance between the two strikes. So between 185 and 180, that's $5 times 100. So that would be worth $500, that spread. And you paid 2 over here, right? So you can see the stock doesn't have to move up that much, just has to get above that 185 level and then you hit your max gain, and you can see that you've more than doubled or approximately doubled your money.
Mm.
So we'll get into that even more, but that's a nice
And
feature of debit spread.
what kind of DTE do you use for these?
Yeah. So this it depends on a few things. So if I think it's less risky if you go further out. It can be less risky. Now, the problem is you do have every 3 months something called an earnings call or an earnings release. Every public company releases earnings, right, once a quarter. And sometimes you can get big moves up or down, but most of the time not terribly, right? So sometimes we may want to avoid
Avoid that.
an earnings release. So maybe we know that, well, it looks like we can see here, there's, I think this E signifies earnings somewhere around August, 1st of August. It's going to be an earnings call for Berkshire. So you may want to only do a spread that expires right before that earnings, so you don't have to hold that spread over the earnings date, right? Because maybe if there's bad news and then it spikes down and then you just kind of lose all your money. But it could also conversely be good news and pop up and you lock in your max gain. So it's kind of a two-edged sword that cuts both ways. Me personally, I kind of like the 60 to 90 day range, but it's hard to do without running into earnings a lot of times. So so what I tend to do is I do kind of less than 60 or 90 if I don't want to hold it over an earnings date, or if I'm fairly comfortable with the stock, I'll maybe even go longer and go up to even 6 months, right? If I'm just like, well, it'll give me a couple of earnings calls and maybe some of them will be good, right? And generally you've got to think that over longer spans, the general trend on most stocks is up. The overall stock market generally, most of the time, trends up. The economy, most of the time, is growing and trending up, right? So I tend to have more of a bias of being bullish than bearish because that is generally what happens most of the time.
How much of your money does it tie up for that period of time?
It just ties up what you spent for the spread. So in our example, we spent $200, right? So you just tied up that $200. I mean, you can sell it at any time. You don't have to wait for expiration. As the stock goes up, and let's say it's only been a few weeks, you should still see gains in your debit spread. You just probably won't get to your max gain of, or max. I wouldn't call it gain. It's not all gain, but your max position. I don't know what you call it. You wouldn't get to that $500 max price until expiration usually. That's kind of the one downside with debit spreads is you kind of have to wait if you want to hit that max price of $5 that we talked about. Okay, any other questions? And don't worry if it's still a little bit mushy in your mind. We're gonna go over some of these things until you get it right. And this won't be the only session, and we'll have some recorded sessions hopefully coming here soon, and we'll have some better diagrams for that.
And just to piggyback on that, Stu, I think a lot of times you're not going to necessarily hold things until expiration.
Yeah.
And I've had many times when I've actually got 80% or 70% of my max potential out of trade in just a week or so, or sometimes even less if the stock really moves quickly. And sometimes at that point, I've realized much more worth it to take that money out and use it elsewhere and have other opportunities than hold on to that position long term and just for the extra few percentage points. So
Yeah, that's a good point.
There's a question from X1, our friend, on the chat.
Oh, there is. Okay, great. Let me see if I can. I'm sharing my screen, so it closed out.
Hi everyone, it's Shinli here.
Oh, hey Shinli, how are you?
I'm good, thank you. So yeah, actually I shoot an email, question there. So yeah, if you can.
Yeah. Let's see if I can. Oh, here's the chat. Okay.
I didn't want to interrupt you, because
No. Feel free to interrupt. I think it makes it a little bit more interesting when people interrupt.
Cool.
Okay. Yeah, when buying call options, expecting the price to rise to make a profit. So what factors do you consider before deciding whether you're going to buy call options or buy put options? Yeah, no, great question. And that's actually part of the slide presentation. So we'll get to that. But basically, I mean, a lot of it you guys have learned. I don't know if Shinli, if you're a student of, I think you may have said you were a Philtown student, but
not student, but I attended the
you attended.
workshop.
Okay,
Yes.
so you're at least familiar with, Philtown's a value guy, which I consider myself a value guy, and so what you're really looking for, right, is undervalued stocks that are trading below what you think their fair value is, with the hope that there's kind of a reversion to the mean, reversion to fair value. And so if you're buying it kind of when it's on one extreme where it's trading very cheaply, the hope is that there will be some natural pressure to push it back up to fair value. And then we'll also talk about kind of looking at technicals like charts and trying to identify maybe different price levels where there appears to be a lot of buying activities, which we would call a floor of support, right? And so you can kind of identify from looking at different charts if a stock repeatedly hits a certain price level and bounces back off of it, that would be kind of a floor. If it's hitting a price to the upside and keeps coming down, then that might be a ceiling. So we'll kind of talk about that throughout the course, where we're looking at both fundamentals, meaning the valuation of the stock, and then we're also looking at technicals, meaning kind of the price action where people are buying and selling this stock, and that will help us know where to place a trade.
When you're talking about technical analysis, so are you using those three indicators as Phil does, like MACD, and then stochastic, and also moving average?
Yeah, so me personally, no, yeah, MACD I look at, RSI, and I kind of look at Bollinger Bands as well. Bollinger Bands, you can put them on a chart and they just show kind of a one standard deviation move away from the current stock price. So, and I'll show that, maybe if we have time, I might show it a little bit today. I know we're running kind of short on time, but if not in this session, the next session, we can kind of go over the different technicals that I look at. But honestly, a lot of those technical indicators are not super strong signals, in my opinion, and often fail. Like it may say buy, but like, my experience, it's not like a screaming signal to do something. It just may be a one more indicator that something is maybe oversold or overbought, and it could be turning around soon or is starting to turn around. In my opinion, the strongest technical pattern, I guess, is just a flat out simple. The easier it is for you with your naked eye to identify, like, this level keeps getting hit and it doesn't break through and it just bounces back up off this level, meaning a support level. If you can see that fairly clearly, then that means it's pretty strong, and it's a pretty good time to potentially buy the stock when it's hitting one of those floors. So we'll continue to talk about that, but that's an excellent question. It's a great question.
Do you use Fibonacci's as well, or just the ones you mentioned?
No. I'm kind of like with Warren Buffett, where, you know, try to keep things simple, and I don't know. Some of it seems, sometimes you think like this is voodoo, like people using Fibonacci numbers and all that.
Yeah.
But if enough people believe it, then it becomes a self-fulfilling prophecy, and like suddenly you got all these sellers who are like selling at like, you know, the 50, or buying at like the 50% retracement, whatever level, you know. So yeah, and that's one thing too, is like, don't get too caught up in like your beliefs, and just kind of go with the evidence that's presented to you. So look, if Fibonacci seem to be working on a particular stock, maybe it's just because a lot of people believe that it'll work, and therefore it works, right? But I don't personally use that. But if you guys use something and it seems to work, let me know.
Oh, I
I'm
couldn't
always
figure
open
that
to.
thing out.
Is that what you use, Salim?
I couldn't figure it out.
Yeah.
That's
Okay.
yeah, I was like, forget it.
Yeah. Is
And
does Phil Town use that, Fibonacci's?
Yeah, when he teaches the
Yeah.
bull put spread, he puts the Fibonacci's on there to figure out where to get out.
Okay.
Yeah.
Well, maybe there's
We
something
just
to
touched
it.
on it, but they were, yeah.
I think it is. I think it is a lot partially because there's enough people that use Fibonacci that it does work to a certain degree. Because even myself, I'm not necessarily a believer in like, oh, there's just going to be these different levels for no reason, but they're just going to hold because they're Fibonacci figures. But I do find myself using like the 60, it's like 62.5. So I just kind of ballpark like 60%. Gain sometimes, and I'll just use that, and it's oftentimes is pretty close to the so it can work. I don't know why it works, but sometimes it does.
The only explanation I guess I could think of for it is you know, isn't Fibonacci like fractal math and all that, and like you find fractals in nature, and and so like if nature is built with all this fractal geometry, then maybe built into like human psychology are these fractal levels of like fear and greed, and so people are like buying and selling after you've had a certain percentage of loss or something, because it's like we're not built to handle that, and so people sell out, or I don't know. That's the only like maybe explanation that I can think of for why it might work, other than just that it's self-fulfilling.
Because then it's
all the
one.
If all the Wall Street guys use it, then it becomes self-fulfilling, right?
Right.
Yeah, it doesn't make a whole lot of. I mean, I've researched the Fibonacci numbers sequence quite a bit just because it just seems so odd. But yeah, it seems.
Now we need to figure out what the Robin Fibonacci is. Robin Hood Fibonacci.
Yeah.
All the Robin Hood traders affect the market just as much nowadays.
Yeah, exactly.
Do we need to use Robinhood for this?
No, you can use whatever, as long as, you know, I just may not be able to show you exactly, depending on what the product is, how to place a trade and all that. So if you can figure that out, you can use whatever. I was going to maybe show both Robinhood and Think or Swim, which is TD Ameritrade.
Yeah.
You know, how to do things in those, because it seems to be like two popular ones, at least here in the US.
That's what we used, yeah.
Oh, okay.
And then I've been trying to do stuff on Quest Trade, another one, and it's just, once you get used to one, it's hard to switch over when you're not really experienced.
Yeah.
But I don't mind getting Robinhood, but yeah, if you can do it TOS.
I think in Canada, somebody was saying it may not be available or something. I don't know.
Which?
Is Robinhood available in Canada?
Don't know.
No, it's not.
No.
Oh, well, there's the answer to that.
Yeah, so that's kind of a bummer. There's another one called Webull that I just like was looking at. Somebody showed me that. It's got some cool charts and stuff in it. But well, let's
will you be showing mostly Thinkorswim, or what would you be using mostly?
Yeah, probably Thinkorswim, and then maybe some Robinhood. I know it's popular here in the States.
A lot of people seem to be using, what's the IB, something brokers?
Oh, Interactive Brokers. Yeah.
Yeah, but I don't know anything about it, whether it's good or.
I've got an account there as well. It's to me
that's another one that's across both sides. Like we have that in Canada as well.
So you have Thinkorswim and Interactive Brokers?
That's right. Thinkorswim, we can't buy Canadian stocks with Thinkorswim up here.
Oh, okay.
Which is odd because TD's Canadian, but anyway.
Okay. Well, yeah, I'll have to think about that.
American.
So, and I know we're kind of running short on time. So we'll see how far we get, and maybe we'll go a few minutes over since we're recording, and then people can go back and watch it, even if they have to drop off. So just really quick, and we'll kind of breeze through this part, but the point is, so you've probably heard of the Black-Scholes model, the Black-Scholes-Merton model. It was these are names of 3 professors that developed this model for pricing options, I think back in like the 70s. And it's kind of a brilliant like equation, and as far as trying to price these options, stock options, but there's some problems with it, with the assumptions that are used in this pricing model. But the cool thing is that you should be happy that the BSM is kind of a poor mechanism for pricing options, because then you can use it to your advantage and exploit it, because you can buy these options that are sometimes mispriced, and then you can profit from that mispricing. So let me just explain a little bit in these other slides. So for instance, according to the BSM, the Black-Scholes-Merton model, the stock market is efficient in that it perfectly reflects all publicly available information about stocks, right? This is known as the efficient market hypothesis, right? People say, whatever new information comes out, the stock market immediately prices that into the price of every stock, right? And so you got this funny cartoon here where they says, why didn't they pick it up? They must believe in the efficient market hypothesis. So if you believe in the efficient market hypothesis, there's no way really that you can beat the market or make money from the market. So you might as well just buy the market as a whole. For example, just invest your money in an index fund, because you can't do better than that. The market is always priced fairly, right? And according to the BSM, any new information about a stock is equally likely to be positive or negative. So stock prices are just as likely to move up or down at any given point in time. So it's 50% odds that it's going to go up this next tick, and 50% odds it's going to go down this next tick, or this next day or hour or whatever, right? Just like a coin flip. But you get those, they're saying that you get those chart patterns though, right? Just because, for example, when you have a coin flip, a fair coin flip, you're not always going to alternate between heads and tails. You might get 5 heads in a row, and then 2 tails, and then 5 heads again, right? That's certainly possible. But they're saying it's just an equal chance of up or down, which these are things that I don't necessarily believe in, that many don't believe in. This is what creates the opportunity. So also embedded in the BSM model is that asset price movements, so like stock price movements, are random, and their percentage returns follow a normal distribution. So this kind of goes back to what I was saying about the financial crisis, and where everyone's models said that, the likelihood of that sort of a crash, and the crash in the housing market and a cascading effect was like, the likelihood of that was like way out here, where it was like multiple standard deviations away from the norm, which means it's very low likelihood of occurring. But then it occurred. So option pricing model is assuming, for example, that you'll have a certain range of prices and that roughly 68% of 68% probability that you'll end up within that range of prices, which is 1 standard deviation. 2 standard deviations would be out here in the blue, etc. So if we're looking at a stock chart, this is kind of what that bell curve would look like if you overlaid it on a stock chart, right? So BSM would say the most likely future price would be on this dotted line here. And the most likely range of future prices, like with a 68% 1 standard deviation probability, would be within this cone here, within these solid lines. You'll notice, as kind of a side note, there's a slight updrift to this dotted line, and that's because built into the model is an assumption that stocks drift up at the rate of the risk-free rate, which is usually like the long-term treasury rate. So maybe right now 1 to 2% a year, and so there's a natural kind of drift up in stocks. So so one thing to know is, so okay, if the foregoing about the BSM is true, then why do we see like 30 to 40% peak to trough swings every year, right? I was just going to show you. Just go back here. So let's look at Apple, for instance, right? So Apple is probably one of the largest companies out there, right? It's a blue chip stock. It's got over $1 trillion market cap. And so it's not like there aren't a ton of people looking at this stock and its fundamentals and its financials and everything every single day, right? But if the market did price things efficiently, would we really have such a huge swing in the value? So if every price is the fair value at the time, then we're assuming that Apple's fair value changes by, let's see, anywhere from 140 to 360, right? That's a huge range. That's an increase of more than 100% since end of, what is this, or since end of 2018, beginning of 2019, right? So just over about a year and a half, 18 months, do we really think that Apple's underlying intrinsic value has fluctuated that much? No. Or is it the case that psychology comes into play, individual psychology, crowd psychology, and the mood swings of the market come into play, and it's kind of whipping this stock around, and probably fair value is in a much tighter range. Let's say we really did our math and we assumed that fair value was around $280, right? If you did find a fair value that you were really comfortable with, then you would know that maybe you'd want to buy when it's far below that value, and you would be more of a seller when it's far above that value, right?
Yep.
And so I've always found that interesting. In real estate, things like that, you don't ever see your house fluctuating in the last 18 months by 120%, right? I mean, I don't know of anybody's home that fluctuates that much within 18 months, but for some reason stocks do, and very widely followed, widely known stocks, even like Apple, have these huge swings every single year. And so that is one thing to kind of keep in mind. You can profit from those big wild swings, and it's great to just have your anchor point so that when you want to be a buyer and when you want to be a seller. Go back to the presentation. All right, yeah, so I kind of covered this, right? So how to exploit the flaws in that option pricing model? Well, we want to, it's just very simple, buy low, sell high. So it doesn't matter what price the stock is trading. Even though Apple, if you remember back at the chart that I was just showing, when it was trading down at the 140 range, the Black-Scholes model would tell you that there is an equal chance, even a year from then, that it would be higher or lower than that price, right? And maybe we say, no, like I really think it's not just a 50-50 chance there. I think it's more like 80% chance it's going to be higher in a year from now than this current price, because I'm looking at the fundamentals. I think it's worth a lot more than this. I'm looking at the technicals, and like 140 is a very good support level, and I don't see it breaking through that support level anytime soon, right? So maybe in your mind, the real probability of Apple being higher than 140 a year from now is like 80%. And the market's telling you and pricing options as if that probability were only a 50-50, right? And that's where you can benefit. You could buy a call option, for instance, and maybe you buy an out of the money call option, and the market's assuming it's never going to get as high as your out of the call option, out of the money option. But in reality, you feel like it probably, I mean, it's got a good chance of hitting that price. So you want to tilt the odds in your favor. Okay, so we buy a long position. So a debit spread using calls is a long position. If you did a debit spread using puts, that would be a short position. But so you want to go long when the stock is trading far less than what your fair value is, and we will talk about how to estimate a stock's fair value in a future session. So that's not for today, but that's one component of this course, right? Is how do we kind of gauge what fair value is? And then we want to buy options, go long when the stock is kind of near support levels, right? So on this chart, this green is support. You can see it hitting here and bouncing off. And oftentimes, what you'll notice is a prior resistance level. So back here, it seems like it was hitting the ceiling. Once it breaks through, often becomes the floor of support. You may have learned that already, but that I've found to be true a lot of the time. Not every time, but a lot of the time.
So what makes those work? Like, it just seems like a Fibonacci where it's just voodoo.
Just like voodoo.
Yeah.
Yeah, I can kind of, to me, I can kind of wrap my head around this a little bit better. So, you know, when it's for whatever reason, people are thinking that maybe this is somewhat pricey, and so people are selling off every time it hits this, let's say this $8 price level, right?
So that'd be like taking profits.
Yeah, taking profits, right? People are taking profits there, and it's almost like a self-fulfilling prophecy, where if it happens enough, then it's like everybody starts to be like, I'm just going to take profits at that $8 level, right? And so I think the not psychology, but the explanation for why then it doesn't dip back below after it breaks through is because if this gets so strong that people are keep selling every time it hits the $8 level, and you actually have enough power to push through all those sellers, right? There must be
That one
something
there,
legitimate going on.
that
Like
one there was
where,
probably earnings.
yeah, like an earnings, something got a lot of people bullish on the stock. Some news, some event, right? Some realization about the company got people thinking, no, this is worth more, and took out all. There's probably a lot of selling pressure here and a lot of fighting between the buyers and sellers, and there was just too many buyers, and it overwhelmed them, and we started going up, right? Until you get to like the next level, whereas people are like, oh, okay, that's getting kind of pricey, right? And then you wander around in the wilderness for a while until maybe something else happens or some other realization comes up where the majority of people in the market are like, okay, this is actually worth more than $14. And then so you kind of have these fits and starts of price movements. And one thing to remember, or one key thing that I learned is, and you can see this when you look at charts, right? You'll have little spurts, little short periods of time where the stock really moves. This is true for most stocks. And then you'll have a big span of time where it's just chopping around, right? And not really going anywhere. And so you just don't want to, you want to try and capture those big moves and not miss them. And so it's true for the overall market. You saw that with, on the downside in January through March, and you really had a handful of days where it was like the majority of that downside. And then on the recovery end, usually in most recoveries after a recession, you actually regain 2/3 of the kind of the upside within 1/3 of the overall recovery time. So short story is, prices move fast in a short period of time, and that's where you get most of your gains or losses. And so you kind of hope that you get something during those periods of time. And so that's why I think these support and resistance levels can be pretty powerful, right? And even if you see something break through, then it could be an indicator that it's heading higher.
Thank you.
Yeah. So, and I know we're going pretty far over. Let me just try and finish off with talking about these debit spreads. We already kind of talked about this a little bit. Let me see. Oh, looks like I got the wrong chart on the wrong slide. So we need to reverse that. So this is the bearish one, not the bullish one. All right. So ignore this chart over here. I'll have to fix that. So let's just flip to the other chart and so you can see it. But like I said, you're buying a lower strike and selling a higher strike call. Typically, I like to do it near the at the money area, right? So where the current stock price is. So in this example here, you're buying this $40 call, and then you're selling this $45 call. And so here the break even's at 42, so you must have paid $2 for that, because at $42, your call, this spread would be worth $2. If it goes up to 45, since you sold that, you can see on this profit loss chart, you don't gain any more profit, even if the stock keeps going up, to 50 or 55. You're capped out at this level, this $300 level of profit. Which the way they got this $300 level of profit is you took the distance between your strikes, which is $5, right? That's the maximum amount that your position could be worth, is $5 times 100. And you paid 2. So 5 minus 2 is 3. So that's your max profit. So the max value of your position is 5, but your max profit's 3 because you spent 2 for it, right? Does that make sense?
Yep.
Okay. Now on the downside, your max loss is at 40 because at $40, your long call option would be worthless because a contract that gives you the right to buy at 40 when the stock is trading at or below 40 is not worth anything. Your $45 option that you sold is also worthless. So everything's worthless. So it's all worth 0, but you spent 2. So that's why you lost $200, anything below this price here. Now, kind of in between this area here, you still lost money. You just didn't lose your the full maximum loss of 200. Maybe here you lose like $100. So, and then the same thing on the upside, like in between 42 and 45, you'd still make money. It's just you wouldn't make the full amount here. You wouldn't make the full 300. Maybe you'd make 200 or 100. So that's how a debit spread works. So we kind of talked about the fact that for you to realize this max gain of 300, you would have to hold it through expiration, because the way that it works is anytime before expiration, you have some time value left on your options, and so it's going to prevent you from realizing this max gain. So maybe like even a week before expiration, if you were up here at the $50 range in the stock price, your position would maybe be worth like $490. So it would be pretty close to max, but it wouldn't quite reach the max until the last day, the last hour, when all the time value is squeezed out of these options, and these options are just purely reflecting the intrinsic value based on the price. I know that's kind of a complicated explanation, but just know it's kind of like in math, like what is that, like an asymptote or something? It's like you never get to that, you never hit the line actually until, well, in those you never do, but here, yeah, until expiration, you never hit the line. Let's see, Marty, did we lose Marty? I think she just came back on. Okay, so that's your bull put spread. Now ignore this over here. So this is your bull call spread. This is your bear put spread, and this is the opposite. If you expected a stock to go down, this is a position you could take where you're buying the $40 put, and you are selling a lower put for 35. And so you are hoping that the stock will be below 35 at expiration. And you must have paid $2 for it again here, the distance between the break even and your long put. And again, your max gain is $300 here. I think it's easier to kind of wrap your head around the call side. Put side, sometimes it takes a little practice to get your head around. And honestly, the majority of my trades, like I said, are going to be long. So we're going to be on this side with a bull call spread, because naturally I'm kind of looking for undervalued stocks. And even if I find an overvalued stock, in my opinion, it's really hard to be short things, because number one, the overall trend of the market is generally up, so you're fighting against the current. And number two, a lot of times things that we think are expensive, the rest of the market doesn't agree with. Right? I think you can probably think of a lot of stocks that you've thought were expensive. They look expensive by the numbers, but truly aren't. So I didn't know that this GIF would work. I thought it was just an image. So So it's news to me. So the wide debit spreads, besides, like you said, Marnie, decreasing your volatility, because it will. I mean, this will be less volatile than if you had a straight up call option, because you're really toning down the delta by doing this, and you're also mitigating time decay. So theta is the Greek that we use to measure how much your option will decay every day that it just sits there. And for a lot of stocks, it's maybe like $1 or $2 a day or a lot of options. Just really depends on the option. But you do have time decay with options, because the less time you have, the less your option is worth, which kind of makes intuitive sense. So when you buy a call and then simultaneously sell a call, it has a countering effect. So your sold call is kind of countering the effect, the losses due to time on your long call, right? And so you don't have to worry as much about time eating away at the value of your position. Is there somebody have a question there?
No.
Okay, I thought I heard somebody. Okay, so and then also, does Phil talk about like volatility, implied volatility, stuff like that in his course?
Well, we didn't get taught directly by him.
Okay, well, by his people.
Oh, that didn't. I don't recall that, or maybe the others.
Okay, so another important option Greek is Vega, which tells you how much your option will increase or decrease in value for every percentage change in implied volatility. So every option has an assumed level of volatility built into the price of that option. So the more volatile the underlying stock.
Yeah.
So think about, I don't know, what's a volatile stock? Like Roku. I don't know if that just came to mind. That one kind of whips up and down pretty quick. You got like Tesla probably whips around a lot. Those ones, their options are going to be more expensive because they're more volatile, because a more volatile stock has a higher likelihood of hitting a wider range of prices, right? So if you remember back to those charts I was showing, with that cone, right? That cone would be broader probably for those stocks because they just naturally whip around like 20% a month or whatever, right? Up or down.
Is that so they're a little riskier then? So does the premium price sort of give you an indication of
Yeah.
more volatile than another one? If it costs more, then it's a little riskier or a little more volatile?
Yeah. This GIF is really distracting on my screen, by the way. Yes. So if you have a stock that has high implied volatility, and it's called implied volatility versus just volatility, because it's almost like it's the resulting number. So if those options are in demand because people think the stock could move a lot, right? Demand is going to drive up the price of your option because people think it's going to be more volatile, and so you're going to have a higher implied volatility number. But so it's not so much that it's like the implied volatility caused your option price to be more expensive. It's almost the opposite, where it's like just natural demand for these options, and also natural the people selling the option, right? They want to be paid more to sell you that option because it does have the chance of going up a ton in like 2 weeks, right? So they want to collect a hefty premium because maybe they're basically selling their upside, and if they're going to miss out on the upside of a volatile stock, they want to be paid handsomely for it. So yeah, volatility, expected volatility, future volatility will affect the price of your options. And you have to worry about it if you are just buying a straight up call, right? You're just buying that 180 call that we talked about before, then you kind of have to worry about volatility. And you want to buy when volatility is low, meaning expectations for this stock moving around quite a bit is low. That's when you want to buy. You don't really want to buy when people are selling it for a lot of money because maybe expectations of movement are high. But if you are doing a spread where you're simultaneously buying one and selling one, those two, again, just like with theta, they net out. And so it kind of, you don't necessarily have to worry so much if you're buying at a high volatility time period or at expensive prices, because while you may be buying a call that's expensive, you're also selling one to somebody else for an expensive price.
Mhm.
So that's the nice thing is this. That's why I think it's a great trade for, especially for beginners, is because a lot of these things that trip up people when they first start with options are mitigated with debit spreads.
Mm. Do you tend to choose a couple of companies and stick to them, or how do you choose your companies?
Yeah, and
Or is that in that conversation for another day?
yeah, it's hard to fit all of this into one session, so it's probably a conversation for another day. But I'll
Okay.
just briefly say that I think you should have like kind of a short list of maybe 10, 20, at most 30 stocks that you follow, just so you get to know the character of those stocks, how they move, what the different price levels are, right? So you can kind of at a glance know, oh, this is pretty cheap compared to where it's been for a long time, right? So that's all I'll say about that now, but we'll get into that more probably in a future session. We already covered this. You know, small change in your stock can result in 70 to 100% gains when you have these type of spreads, as we showed in that example with Berkshire. And it also has an added benefit of helping with sell discipline. So because you're capped out on your gains, you don't have this temptation to, you know, as the stock goes up, keep holding on to it in hopes that maybe it'll go up more and maybe it'll go up more, right? And then you hold it for so long and something tragic happens and the stock drops like a rock and you lose all of those gains because you just never sold or you never knew when to sell or didn't have the heart to sell, right? Sometimes people get attached to their underlying stocks because they really like the company and it's you just don't want to part with it. Those are kind of real things, but this basically sets a price at which it doesn't matter how high it goes. You have a max gain, so you might as well sell it once it gets to that max gain. And we'll talk about in future sessions that you can pretty easily from debit spreads make some adjustments as things go against you. Maybe it goes down and you're expecting it to go up. You can make some adjustments to kind of right the ship and get it back on track. And it's psychologically favorable, kind of like what I was just saying, where it's lower volatility, right, compared to a straight up call. And you know, if something drops drastically, you'll still lose money, but you won't lose as much money as you would have had you bought just a straight up call. But maybe if it drops enough and it gets really cheap, you say, now I'll just roll this over. I'll sell this spread and I'll still get some money for it. And I'll buy a straight up call at this lower level. And now I'm springing off an even lower level with a straight up call. So it's psychologically beneficial. So this is the last slide, I promise. I know we're about a half an hour over what I anticipated, but oops. Sorry, I just had something pop up on my screen. So kind of some general guidelines around if you're wanting to attempt this 10K options challenge where you start with about $2,000. Some general guidelines, and I could probably type these up and I'll put them on the website sometime soon. But this is like I was saying, you want to create a list of your favorite, I say liquid stocks, because this strategy works best, and basically any option strategy. It is hard to buy options on a stock that does not have a liquid options market. So
What does that mean?
So that means that there are a lot of people buying and selling options for that stock, which tends to drive the bid-ask spreads to be smaller. Some options you'll see have a huge, wide bid-ask spread. So bid is the price that someone on the other side is willing to buy the stock from you at, and ask is what they are willing to sell you the stock at, right?
Mm-hmm.
And so if that's a huge, wide range, if you bought an option and then you wanted to sell it and had to get out, then you got to sell it potentially at a fairly low price. So you can actually just lose money through that bid-ask spread. You kind of have to get over that to make money. So most
You want busy stocks, popular.
yeah. Well, generally, as a general rule, the larger the company, market cap wise, like an Apple or a Microsoft, it's going to be super liquid, and those bid-ask spreads, even on their options, are like a penny or 2 pennies, right? If you have some smaller companies, even if they're $5 billion, right, it could be a 50-cent spread, which is times 100 is $50, right? And we'll talk about when placing orders, though, even on those kind of stocks that are not as liquid, you always want to do a limit order, and you always want to place your limit order at the midpoint of the spread. You never want to pay the actual ask price, and you never want to sell at the bid price. You want to do it in between, because oftentimes you'll get it in between. So, okay.
And Steve, sorry, I have to interrupt.
Yeah.
With regarding the liquid stocks that you mentioned, is there any relation with, when in the stock option chain, you can see the volume and also open interest? Does it related to them?
Yeah. So that's one way of gauging how liquid a stock is. If you can see the volume and the open interest, right? If they have a lot of open interest, a lot of volume, then it's probably a fairly liquid stock. But if you see like there's an open interest of 10 or something and volume of like 1 for the day, may not be the best stock to use for options. Okay. So you're naturally going to be pushed toward bigger companies, more popular, smaller companies maybe. But nowadays, I think the market's getting more and more liquid as time goes on. So I think versus 10 years ago when I first started, there are a lot more stocks that are fairly liquid. They have a fairly liquid options market. And I think even if you see spreads of like 20 cents, it should be okay, liquid enough. But if you're seeing like 50-cent spreads, probably want to pass those up. I don't know. You can still do it if you can get it at the midpoint, but that's just a general rule, is to go for more liquid stocks.
So when you say the stock is liquid enough, so do you have any like a benchmark for the quantity of, for example, volume and also open interest? Do you do like, you have the benchmark, for example, open interest has to be 100, above 100, or, some sort of like.
Yeah. I guess I've never thought about, that's a good point. I mean, I can go back and look at a lot of my stocks and get a benchmark of where the open interest and volume is, you're going to see most of the volume and open interest right around at the money price. So so the deeper in the money you go, the less liquid you're going to get, and then the further out of the money you go,
Yeah.
you're also going to get less liquid.
That's
But
nice.
I would say, I mean, even if it's yeah, definitely if it's above 100 volume, it's probably pretty good. Open interest is a bit more tricky because you know, if you're going out longer, so longer dated options, you're naturally just going to have fewer open interest and fewer volume. But closer to the present time, maybe if you're only going a month, 2 months, 3 months out, you're going to have higher numbers. But I'll have to think about what exactly would constitute a good rule of thumb. But even though you may not see a higher open interest, I don't think that's the most important number. I think looking at the bid-ask spread and how wide that is the better tell, because you also have every month or so, for a lot of options, you have new months coming online. So for example, for XYZ stock, maybe today they don't have a October set of options available, but next week they start selling October options, right? They just put them out on the table basically, and now people can start doing October. And so because it's brand new and hasn't been around as long as maybe the September options, you're going to have naturally less open interest and less volume.
Yeah, makes sense.
Yeah. Okay.
Thanks.
Yeah, no problem. So we already talked about this. We're going to buy when there's a favorable setup, right? Fundamentally and technically. And then don't put more than 10 to 15% in each trade is kind of what I would do. So if you're starting with 2,000, that means you're roughly in the $250 per trade range, which means if you're doing an at the money spread, at the money you can get these debit spreads for about half the width of the spread. So if it's a $5 spread, you know, 180, 185, then that would probably cost you around 250. So that would be right in the range of what we're looking for to be 10 to 15% of our portfolio value. So I would be looking for $5 spreads, right? And one thing I didn't put on this list that probably I should have is if you think about it, you know, with debit spreads, we just need a small move up in the case of a call spread, or down in the case of a put spread. We just need a small move, you know, going from 180 to above 185 in that one example to be able to make our max gain, right? So $5 move for a $180 stock, I don't know, what is that percentage? Percentage-wise is not huge. Is that like 2.5% or so, 3% maybe move that it has to make your max gain? But if you buy a lower price stock, let's say a $20 stock with a $5 spread, then you have to have a greater percentage increase in the underlying stock to achieve your max gain. Maybe you have to have a 10% gain in your underlying to achieve the max gain. So I think
With that $20 stock and $5 spread, I think you would have to have a 25% gain.
Well, but and it gets a bit complicated. But if you're buying a $20 stock, a spread on that $20 stock, you would probably actually go in the money on your long call. So you'd be dipping in the money and then selling a little bit out of the money. So maybe you go like 250 in the money, 250 out of the money to make your $5 spread. So you'd only have to go 250, which would be maybe 10%, you know?
Yeah, gotcha.
Yeah. Okay. So it depends. And we can show some of these examples. So in that case, what I'd probably do is, instead of doing one $5 spread on a lower price stock, I would do a and I should have just whiteboarded this, apologize. I would just do like maybe a $2 spread or something like that and do 2 of those, right? Because you could always do 2 $2 spreads, $100 each for a total of $200, something like that. Okay, and then as a rule, if you lose 50% of the value of your spread, that means something went wrong with that trade, and so you should maybe get out while you've still got 50% of the value there left, especially if it's getting within 30 days of expiration. That's when I would seriously consider jumping out or adjusting. So we'll talk about later on some different adjustments you can make if you find yourself on the losing end of a trade. And then lastly, I would kind of generally, this is not always the case, but if it's been a choppy ride, right? Maybe you bought a spread that expires 60 days from now, and throughout that first 30 days, it's just been like up and down, and you kind of are in the profit range one day, and then you're in the loss range another day, and it just keeps going profit loss or whatever, and you're not really getting any momentum to the upside, then if you're within 30 days of expiration, and you do find yourself with a 50% gain, I would take it, 50% of the max gain. But if early on the stock, and this has happened to me quite a few times, where it's like the day after you buy, some news comes out or something happens and the stock just rockets up and is pretty, now your position is pretty far in the money. I tend to just let those ride, because now the chances of it coming back down are pretty small, and I could just wait the full 60 days until expiration. It's a good chance that I will get my max gain, right? So in that scenario, I'd probably just let it ride until I got pretty close to my max gain. All right, so I think that's it for, that's it for the presentation. Let me turn my video back on here. Okay. So does anybody have any questions? Any thoughts about what you'd want to talk about next time, or
When's next time?
Yeah, so probably, we're Danny is going to help me with some of the recorded sessions, right? And we're trying to get those for you guys as soon as possible, and that would be easier for us, right? Because then people can just learn at their own pace. But I'm thinking in a couple weeks we'll probably have another session.
Are you in Hawaii?
No, so this is fake. This is this is a Zoom background.
Oh, geez, I'm sitting here just drooling.
Yeah, I wish.
Yeah.
Their COVID cases are pretty low, so it seems like a good place to go. So,
Okay.
Anybody have any questions before we end this session? I know we're fairly far over the time.
That's okay for me.
Yeah. Some people like it. Some people I know are always annoyed by it. Because people are busy, so.
Yeah.
But,
I
don't mind it. Sorry, what was
What time
that,
is
Marty?
it in Australia over there?
Oh, no, I was saying just looking forward to the next one.
Okay. Yeah. Yeah, isn't it daytime in Australia now?
Yeah, it's nearly, I think, 2:45.
Okay.
It's
Okay.
in the afternoon.
Okay,
Oh,
nice. And it's winter, right?
Yeah. It's cold. Well, I think before your next session, I think that's good that we probably, if we have any question, probably just post it to the Discord.
Yeah.
And then the next session, you can bring it up.
Yep. That would be good. So, yeah, feel free to post your questions. And what we can also try and answer them in the Discord. I mean, that's another reason for having the Discord is, it's not always easy to jump on a call like this. And so sometimes we can answer questions through there. But yeah, definitely, if there's something you want to dig into, post it there, and then we can touch on that in the next session. I mean, I've got some thoughts on what we can talk about in the next session. For example, I do want to touch on, I think one thing that people get tripped up on as investors, especially value-oriented investors, is we're always searching for the beaten down stocks that, on the chart, it just looks like it's like the lowest it's been in the last year or two, right? And we try and find bargains that way, and that's kind of a traditional value approach. But there's actually some good books on momentum and thinking about momentum as also value, but in a different way. Just briefly to explain, the traditional value is where we're hoping that people have overestimated how bad things are at that company or something. That's why the stock sold off, and we're hoping for a reversion, a bounce back to the mean, right? That'll go back up. There's a lot of literature out there and studies done with momentum meaning where you have better price action, positive price action compared with the market. And you see some of those stocks where it seems like they just keep going up and up and up and up, right? And they're finding that really you can look at it as a value stock, but it's a situation where instead of overestimating how bad something is and hoping for a bounce back, you have underestimated how good a company is. Like you saw this with Amazon and Netflix, several years ago, where you have certain companies that are so good that the market can't fathom it and keep up with it. And so people keep realizing this is actually better than I thought. It's a better, it's a better company. They have more ways to make money than I thought. And so the stock keeps going up and up because people are constantly underestimating how good it is. And so those tend to be some of the best winners. And so I guess I would piece of advice is when you're putting together your watch list, don't necessarily count out certain stocks because, maybe they're near their all-time high or their 52-week high. Try and delve into it and to see if maybe is there really a reason and people are still underestimating how good that company is.
Oh, it's good you mentioned that. I've been wondering about it because there are some I see that are and read about that I think they're going to just go further and further up.
Yeah, and it could be for a good reason. And now there are some that are like just overhyped and just pure kind of like I don't know, like those Robinhood guys, right? Just pushing up stocks, and people don't really know anything about the company or the underlying fundamentals. But there are other companies that you'll see for years just start trucking along, going up and up and up, and it's just because the market keeps realizing how good they are. So with that, I guess if there's no other questions, we'll just conclude this session, and feel free to put your questions in the Discord. We'll post this recording as soon as I can. I mean, I imagine it takes some time for me to download it and upload it and everything like that. So hopefully in the next few days. So if you want to watch it again, you can, but more importantly, for those who missed this session, they can watch it. And then we'll try and schedule something in the next couple of weeks.
I guess one final question, Steve. You've been posting things in that 2 to 10K Discord channel.
Yeah.
Aids and stuff like that. Is that something that you're going to continue to do? And is that something you would recommend people look at and break down or actually employ? I mean, I know I've been.
Yeah. I mean, I'm kind of two minds with that. Part of me, it's like, you don't learn things if you don't do your own work, right? And really own what companies you're investing in and So if you're blindly following somebody, you don't really learn. But then again, you know, maybe people want to just see some thoughts and ideas that I have and maybe what I'm doing. So I'm kind of two minds and haven't really made up my mind on what's best. So I guess I'd welcome feedback on that.
Thanks.
But for now, I guess I was planning on continuing to post there. Which lately hasn't been going so well, but I'm just I'm trying to be like Pete Carroll and saying to myself, even though I've had a losing trade there, that it's, you know, maybe my decision wasn't bad, it's just some bad luck, right? This is what I'm hoping. And so over time, you know, you're going to have losers fairly often, actually, and it's just getting used to those and just trying to make sure you have a good process and, you know, that the odds will play out in the end. Okay. Well, thanks everyone. Appreciate you participating today and look forward to seeing you in the next session.
Thank you.
Okay, thank you.
Thanks. Thank
Thanks.
you. Bye.
Bye.